Welcome back to ciLiving. Learn how to invest your money the right way thanks to Rooted Wealth Advisors. They are sponsoring today's segment, and joining me with more information is John Savarino. Welcome back. Thank you for being here.
Jaclyn, it's always a pleasure to be here. I don't have any magic tricks, but I think we can provide some good insight to our viewers.
Well, and this is really cool. The Jaclyn periodic table of investment returns.
Proud of you.
Thank you very much. I was saying to him, it's so much easier just to say the periodic table of elements. But I got it. And so now you are going to tell us what that means.
Yes. So transparently, the Jaclyn periodic table of investment returns is simply a visual that in this example is looking back 20 years and what the investment returns have been for particular asset classes. So typically what this is a visual for is how diversification of asset classes in our investment portfolios can mitigate risk, okay? But really there's two things that I want to discuss here as we come to the end of the year. Typically speaking, we look at large cap equity, which if you look on this table, over the last 10 years, has been the #1 performer 5 out of those 10 years.
So that's this dark blue.
Correct. And so historically speaking, you want large cap equity. But what you can see here is if you look back 20 years, or the 10 previous years, it was not the #1 performer. So historically speaking, there's never one asset class that completely dominates the market.
Right.
Okay? And so for a lot of our viewers who might be nearing retirement or in retirement, this can illustrate why diversity is important from a risk perspective. Make sense?
Yeah,
Okay.
absolutely.
Secondarily, as we come to the end of the year, what diversification can also do for us, it can help us when it comes to taxes. And one of the strategies that we utilize for taxable accounts, okay, so this is non-retirement accounts, is something called tax loss harvesting.
Okay.
So let me give a quick example of what tax loss harvesting.
Oh, look at that! It's a fancy double-sided chart.
Look,
I love it.
I don't give a shout out to JQ enough.
Yes.
But JQ takes care of me. We're really stepping up our game with these visuals.
I love these visuals. Well done. Keep it up.
All right. So let's look at it very simply to say, hey, if all I owned was a large cap equity mutual fund and I sell it at the end of the year because I need money for a new car, for Christmas gifts, like whatever it really is, and I'm realizing a $20,000 gain on that particular position. That's great. I realized $20,000, but we also have to realize based off of our ordinary income tax rate or capital gains tax rate, I could be potentially owing $7,000 in taxes.
Gotcha.
So what I thought was going to be $20,000 in gains now turns into just $13,000. And transparently what I find is a lot of folks do set it and forget it. And that can be very helpful for a lot of our viewers because it takes that emotional element out of it. But what happens in a taxable account, the longer we wait, the more taxes we end up owing, right? And so it just becomes not very efficient. So tax loss harvesting is every single year, this time of year, we should be looking at all of our different asset classes.
Right.
Because what the table just told us is some go up, some go down.
Right.
And we should be offsetting what has gone up with what has gone down. So let me simplify this for a second. If I need $20,000 from my account and I don't want to pay any taxes or I want to pay minimal taxes, I'm going to look at my other investments, my other asset classes. And let's say that I can ultimately realize a loss of $25,000. Losses don't have to be a bad thing, okay? Because what ultimately is going to happen is $20,000 of that loss is going to offset all of the gains here. So there's no taxes owed on that gain that I need for whatever that purchase might be. I actually also get to carry over, or I get to use $3,000 to offset my other income sources, thus saving taxes, and then I can even actually carry over $2,000 to the next year. And so I went from paying $7,000 in taxes to now saving over $8,000 in taxes.
I see. And that also kind of offsets whatever this loss is going to be, because instead of losing a full $25,000, you're getting some of that sort of back to offset. Is that 100%. Correct?
And then we can't ever predict the future, right? But we're simply looking ahead at 2026 and saying, hey, where's our conviction lie to now put those proceeds, right? To put that capital to work instead of just letting it ride in either kind of investment A or investment B. So I know it sounds a bit complicated, but ultimately that's why our clients utilize us to implement those strategies. But genuinely, if you really start to play this out, 10 years, not even pulling any of this money, right? Just consistently tax loss harvesting. I mean, it can save thousands, if not tens of thousands of dollars in unnecessary taxes in the long run.
Right, and mitigating losses on investments that maybe were riskier and didn't perform as well. Now, I have a question, because the only time I've heard of capital gains is in the context of if you sell a property that has been a rental property. Are there other situations where it would be capital gains, is question number one. And question number two, can you do this with capital gains tax on property?
Yes, you can. So really any asset class you can do this. Now it becomes a little bit more difficult because property is not quite as liquid, right, as simply owning a stock in a brokerage account, or what we call a non-qualified taxable account.
Sure.
But that would apply in that particular situation, which I hope that answers your question. And it applies across the board. It's typically easier when we have more liquid assets, right? Like a stock, like a mutual fund.
I see.
Because we can sell and buy it like that.
Sure.
Property, of course, can take a little bit of time.
Right.
Now there are different strategies around that you could leverage, but we'll save that for another time.
Right. I was going to say, I feel like sometimes as we sort of get toward the end of our time, I ask a question that we could have a whole nother 7 to 10 minute conversation about, which is in those situations when you would need to call John and schedule an appointment, and he can explain it to you all one-on-one.
Yeah, we work with a lot of different CPAs, tax law attorneys, when it comes to different cases or scenarios. So we definitely don't try and be kind of that jack of all trades. We definitely lean into our relationship partners.
Wonderful. Well, thank you so much for sponsoring today's segment and teaching us all of this information.
Always a pleasure.